Hi and welcome to Business Tips with Michael Tobian. Today we will be examining the question, what is my business worth? Every business owner wants to know what the value of their business is, but few of them have any clue. Today I'm going to give you a little overview of how we help potential sellers know what their business is likely to sell for. I'm going to hit on the following topics today: valuation methods, profitability, SDE versus EBITDA, adjustments and add-backs, equipment, inventory, and real estate, sanity checks, sellability, and other factors. There's so much more to this topic than what I will be covering, but I hope that after watching this, you'll have a good idea of the basics. Keep in mind, every industry is different, so I'm going to be going over some generic information that applies to most businesses. Some unique businesses have industry-specific calculations that they use that are unrelated to what I'll be discussing. Because, again, each industry and business is different, determining what your business is likely to sell for requires some research. If you're interested, I'd love to take a look at your business and give you an idea of where you're at. Feel free to reach out to me at my website listed below in the description. So let's get into it right now. First one, valuation methods. When my team and I prepare a broker's opinion of value for a client to help them come up with an asking price, we look at a few different valuation methods and present these to our client. The first one we look at is what we call rules of thumb. There are resources available to people in our industry that analyze what price ranges different kinds of businesses sell for. My team and I always carry the latest version of a book called the Business Resource Guide as a quick reference to some of these general rules of thumb. The next thing we do is we look at comps or comparables of other similar businesses that have sold. Other industries use comparables as well. For example, when residential real estate agents advise their clients on an asking price, they will look at what similar homes in the area are selling for. We also do this with businesses. However, with businesses, these comps are much harder to come by because sellers don't disclose publicly what they sold their business for. So we get our comps through a cooperative database of reported information from other business brokers about businesses that they've sold. Confidentiality is a big deal in our industry, so the database doesn't disclose the names of the businesses sold, but it gives a lot of information about what kind of business it was and what it sold for as a percentage of the revenue, profit, and things like that. After we look at these comps, we consider other possible valuation methods, if applicable. We might even take cap rates or industry-specific valuation methods into consideration. Finally, we use what I feel tends to be the most accurate method, which is our own experience. We've sold so many businesses that we have a good feel for what different kinds of businesses will sell for. We can also look at comps in our own database of businesses that we've sold. The last method is, of course, an opinion, but it's an opinion from people that are in the trenches selling companies regularly. The advice of a quality business broker can be invaluable. All right, next up, profitability. A business that's making money is usually going to sell for a multiple of the profitability of the business. When I advise my clients on an asking price, I'll usually give them a range based on an appropriate multiple. They may decide to list it on the lower or the higher side of that range, depending on probably how motivated they are to sell it or their time frame. The multiple that's considered tends to be industry specific and relative to their profitability. Other factors sometimes influence this as well. For example, if a business is a one-man show, it's unlikely to sell for the same multiple as a similar business that has processes in place and a whole team of people running it. I once sold a locksmith business that was literally just a guy who was a locksmith. The person who bought it learned the trade and he took over the business. It didn't sell for a very high multiple because the guy sort of just bought himself a job. If he would have had staff and an organization, I suspect it would have sold for a higher multiple. In any case, we use a multiplier of the business's profitability. The next question that we should ask ourselves is, how do I calculate profit for the purposes of business valuation? Many people have heard of the term EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization. This is a standard way of ascertaining a business's profit potential for a new buyer that's taking over. An EBITDA number reflects the profitability of the business with these adjustments that I mentioned above. If the business has a manager that's running it, the manager's salary is included as an expense. If the owner is managing it, then a reasonable salary for the owner is factored into the expenses. Another way of analyzing profit is through what we refer to as SDE, which stands for Seller's Discretionary Earnings. This is sometimes called SDC, or Seller's Discretionary Cash. This method looks at the profitability with those same adjustments as EBITDA. However, SDE assumes the owner of the business is a working owner, and any dividends or salary of the owner is considered profit. So, if the owner gives themselves a salary, that expense is added back into the profit for the purposes of valuation. Sometimes it makes sense to use EBITDA when considering the business's profit, and sometimes it makes sense to use SDE. Each method will consider a different multiple when valuing the business. A business owner may put $100,000 into their pocket at the end of the day, but their EBITDA may be less than that due to their actual salary being an expense. So that business may use a multiplier of 3 to 5 times of their EBITDA, but only 1 to 3 times of their SDE. The reason this is important is a small business may not be making enough money for a manager's salary to even be a consideration. The buyer will just be running the business themselves, and they only care about the bottom line. How much money is this business putting into their pocket at the end of the day? A sizable business may require a manager. The buyer isn't buying themselves a job. Rather, they're buying an investment, and they need that manager to stay. Most Main Street businesses use SDE, and most mid-sized to large businesses use EBITDA. If someone is buying a small business, they usually are going to work in the business, and they just want to know how much money is going into their pocket. The distinction between SDE and EBITDA is important. I was once showing a business owner some comps, and he had said that he had done some research that said his business should be priced at a higher multiple than I had suggested. We looked up his source, and it was referring to EBITDA. There was no conflict in the multiple. He had just misunderstood the difference between EBITDA and SDE. Next up, adjustments and add-backs. Buyers are eventually going to want to verify the numbers that they've been given during a due diligence period by looking at the business tax returns. For that reason, the financials that we present to a potential buyer in the first place and during the sales process show what's on the tax return, as well as an adjusted income statement that adds certain expenses back into the profit. Tax returns don't always give an accurate picture of what a business is generating in benefit to the owner. Unnecessary expenses, one-time expenses, owner benefit expenses, non-cash expenses that won't necessarily apply to a new owner, like depreciation and amortization, interest, and taxes, are shown as adjustments to a buyer. Because we show these adjustments to the tax return numbers, there are no surprises when a buyer uses the tax returns to verify these things. When I'm working with a seller, we go over each of these adjustments in detail to make sure we get them right. Next up, equipment, inventory, and real estate. The value of inventory and real estate owned by the business is typically added on top of the value of the multiplier used. The reason being is this: inventory needs to be continually purchased by the business and sold to the customers. They can either buy it from the previous owner or they can buy it from their wholesaler. It's a separate consideration. In regards to real estate, a business is likely to have either a real estate mortgage or a rent expense. Oftentimes, the expense is a similar financial burden. In many cases, it's more advantageous for the business to have an actual mortgage, as that turns into a real estate investment over time. Equipment is a different story. Many sellers are surprised when I tell them that the value of their equipment makes little to no difference in the overall value of the business. If we analyze a business value based on its profitability, The equipment was necessary to produce that profit. It's part of the calculation already. An exception to this idea is if the value of a business's equipment is more than the investment value of a business based on their performance. For example, if I own a manufacturing company that's making $100,000 per year in profit, but we can sell our equipment for $10 million, well, the value of the business is going to be the $10 million. In these situations, I usually advise my clients that I might not be the best person to sell their business. They might be better off getting advice from someone that specializes in manufacturing equipment or restaurant equipment or whatever equipment it is that they have. My expertise is in selling ongoing business operations. Next up, sanity checks. Regardless of what valuation methods we use in our analysis, an asking price needs to pass certain sanity checks. Oftentimes, I'll look at the asking price and I'll put myself in the buyer's shoes and see what challenges we might face. If I assume that a buyer is going to put 15 to 20% down on an SBA loan or some other kind of loan to purchase a business, is the business making enough profit for that buyer to provide an income for themselves and repay their loan? What does their risk look like? Do they have so much inventory that it's putting the asking price in a range that doesn't really make sense financially to purchase? This step is all about determining if this is going to be a practical purchase for a buyer. Next, sellability. I highly recommend checking out my video called Is My Business Sellable? I go over some challenges that many business owners face with the sellability of their otherwise wonderful business. Oftentimes these issues are solvable. We cover things like customer concentration issues, keeping good books and records, making your business turnkey, separating yourself from the business, and more. Finally, other factors. I really take some time to learn about a business before I offer a broker's opinion of value, because there are sometimes nuances that are unique to that business. For example, I might be looking at a business that isn't worth all that much money, but they have a very valuable piece of intellectual property. Or maybe a business is making a lot of money, but it's experiencing a decline in performance every year. That will affect things significantly. Maybe a technology business is selling an outdated product, or an online lead generation business is conflicting with a recent major Google algorithm update. Perhaps a business has a high level of residual or passive income. Lots of things to consider here. So, getting an opinion from a good business broker that really knows what they're doing is a great idea. Thanks for listening today. I know that was a lot of information. What's funny is I feel like I really just barely touched on the surface level here. So again, please reach out if you're interested in selling your business, and let's take a look at it. Subscribe and follow for more information in the future about selling your business. Thanks for watching.